You can make a living from just trading double tops and double bottoms. Let me say that again because it's important. You can make a living from just trading double tops and double bottoms. So if you're learning to trade and you just have to learn one chart pattern first, then learn to trade double tops and double bottoms. These patterns occur in every market and on every time frame. They occur regularly as well. I'm going to show you examples from Forex markets, indices and US stocks. They are easily noticeable, they stand out on charts, and they often produce a good risk and reward trade. So in this video I'm going to guide you through the steps in identifying and trading double tops and double bottoms. I'm going to tell you what to look out for in order to pick out the higher probability versions of the patterns, and also the type of things to look out for in order to avoid failed patterns. Of course, these are my own thoughts and my own observations from years of studying and trading the markets, and you should aim to become an expert in your own right so that you can be confident of the trades that you take and the decisions that you make as a trader. Take some time after watching this video to pick out double tops and double bottoms on your charts and notice how they fit the criteria. Pick out patterns that completed successfully and also patterns that failed so that you get a good feel for what works. This way, you're going to be training your brain for success. Let's start then with the theory before we go on to some examples. So what are double tops and double bottoms? Well, double tops and double bottoms occur when price reaches a point in the market where it reverses, pauses, and then retests the original extreme before a second failure at the original extreme results in a significant reversal. Double bottoms are effectively upside down or inverse double tops, and they've got the same criteria, and you'll trade them in exactly the same way. So for the most part of this video, we're going to concentrate on double tops. What we're looking for then is for price to make a high, pull back from the high, and then retest the high before failing at the second high and moving back downwards. The first criteria for a double top setup to be valid is that the market reaches a significant support and resistance level with the first high. This criteria is essential when the market's trending and making higher highs, and preferable but not necessarily critical otherwise. The support and resistance level may be a round number, a whole number, an important price point like the previous day's close price, or it may be a previous high that's resulted in a significant market reversal. Likewise, the resistance may be created by moving averages. Either way, you must be able to identify some level of resistance that has the potential to cause a reversal and a change of momentum. In terms of the support and resistance level, the double top does not have to stop necessarily at the level precisely, but it must have some part of the pattern that reaches or exceeds the support and resistance level. And actually, some of the best patterns break the level twice, once on both of the tops, with the middle of the pattern breaking back below the level. The second criteria is that there's a big rejection move on the second top. The two tops don't have to be at the exact same high. The second top might be slightly lower or slightly higher, or at the exact same level as the first top. What is important is that the second top shows a significant level of rejection of the highs. And you'll only see this by paying close attention to the candlestick price bars, and it may be in the form of a pin bar candlestick or a 2-bar reversal candlestick pattern, or an engulfing candle moving down from the top. If the second top's higher than the first, then there is one additional piece of criteria that's required, and I'll talk about that a bit later. Think about the psychology behind the pattern for a minute. Price makes a high, and it may have resulted from a bull trend or just a strong move upwards, but either way, the bulls are in control, and then our double top pattern creates a shift in power from bull dominance to the bears. When bulls are in control, then they'll take any opportunity to try and force prices upwards. When the market pulls back from the highs, bulls will try to add to their positions, and new bulls who missed out on the move upwards will get in hoping for new highs. These are the traders who will lose out when we take their money. The market moves upwards once again, propelled by this bullish enthusiasm. And often the move upwards is quite strong, and there's almost a vacuum in prices as the market makes it back to near the previous high or slightly beyond. However, the bulls in this sort of case are in for a shock. Prices stop near the high and then reverse quickly. And seemingly out of nowhere, the bears pounce and push prices back down. This is the footprint of the institutional sellers. The big money is seeing value in pushing prices down from their highs. Noticing this type of footprint is a must for all home-based and independent traders. It doesn't matter how many small traders like you and I try to push prices higher. If the institutions want lower prices, then they'll get lower prices. This swift rejection of the second high is enough to send some bulls running for cover, and they'll exit their trades. And the mere fact that they do this will mean that they join the bears in the process of selling. And this is what's called double pressure. Both the bulls and the bears are selling at once, and this creates a powerful force in the market. Some of the bulls who bought when prices were lower are slightly more resistant, and they'll be preparing to hang on to their trades until they get firm evidence that prices are not going to go higher anytime soon. And this tends to happen at what we call the tipping point, and this tipping point is exactly where we enter our trade short. The tipping point occurs when prices close below the low of the middle of the pattern, or when there's build-up near the low of the pattern and then prices break out below the middle. At this stage, the market is making a lower low, and this often spells the end of bullish momentum in trends. This is typically when the bulls give up and the bears move in to force lower prices into the market. Often there's some kind of reaction when prices reach the level of the middle of the double top, and this is especially true where there's congestion at this level in the middle of the pattern. Also, it's more likely if the second high is higher than the first that you'll get some kind of reaction in the middle of the pattern, because the market will probably try to retest the higher high until it puts in a lower high. Sometimes the bulls will not concede easily and they'll start buying at the level of the middle of the pattern, and this can cause prices to rise back towards the second high. And this is exactly the reason why we need to see prices reject strongly from the second high. If this occurs, then it's likely that the bears will start selling again with force when prices get near the second high. And it's also the reason why we need to place a protective stop for our trade above the second high, because if prices go above this level, then we can consider that we were wrong. So pay attention to the price action in the middle of the pattern. If there's too much congestion there and lots of price bars going in both directions, then it's best to give the trade a miss. And look for what we refer to as white space between the middle of the pattern and the reverse back down from the second high. White space is an area on the chart with no price action, a blank space. The more recent the battles on the chart between the bulls and the bears, and the more intense the battles, the more that they're likely to stick in the memory of traders, and the more likely it is that the battle will recommence when prices are in this area again. Ideally, we want a smooth and quick journey down to our target and not to get stuck in a bull-bear war. Sometimes, however, we don't always get what we want and prices behave in a way that we wouldn't have expected, and this is just what happens in trading. It's a good reason to make sure that all your criteria for a trade is met before you risk your money. So where do you find double tops and double bottoms? Well, these are reversal patterns, and so you'll find double tops at price highs and double bottoms at price lows, or swing highs and swing lows. However, they're also a continuation pattern in trends, and so you'll also find double tops in bear trends and double bottoms in bull trends. When they're continuation patterns, they act as pauses in the trend, sometimes halfway through a trend. And they're often followed by a move that's just as strong as the first leg. Let's have a look then at how you set your target in a double top and double bottom trade. Well, you should be looking for at least 1-to-1 risk to reward on these type of trades. Your risk is the distance between entry below the low in the middle top and the high of the second top. And your target should be the difference between your entry point and the highest high in the pattern. This will either be the first high or the second high, whichever's higher. Very frequently there is a reaction at the exact point of 1-to-1 risk to reward, and this is because computers with programs set by the big institutions identify and take these trades specifically, and they'll exit their trades at 1-to-1 risk to reward, and this creates a bull surge in prices at profit target. And adventurous traders can look to take partial profits at 1-to-1 risk to reward and then let the second part of their trade run as a swing trade, hoping to get 2 or 3 or 4 times their risk. When a double top takes place and the second high is higher than the first high, then a requirement that must be met for a double top to be valid, a double top trade to be valid as a setup for me, is that the second high is accompanied by a stochastic or MACD divergence. In a trend, prices tend to make higher highs and higher lows in an uptrend and lower highs and lower lows in a downtrend. When a possible double top emerges and the second high is higher than the first, then effectively the market may well be continuing to trend higher, and the probability of a double top reversal trade is lower than when the second top is lower than the first. However, as long as prices have met a support and resistance level, and at the same time as the second price high emerges, a momentum indicator produces a lower high, then this may indicate a waning desire from the bulls to force prices higher, and this is called a divergence. There's a divergence between the messages received from the price bars on the chart on the one hand and the momentum indicator on the other hand. Prices say we're going higher and momentum suggests otherwise. You can use either stochastic or MACD indicators to measure divergences. If you're using both, then one may suggest one thing and the other may suggest something else. However, when they both say the same thing, then you've got better probability. Don't forget that a momentum indicator divergence is not reason on its own to assume a reversal and a double top or double bottom. All of the other criteria must still be met, and often when markets are trending, they'll produce divergences several times before price makes a turn against the trend. So one final thing to look out for at double tops and bottoms is where price is in relation to the exponential moving averages. I use the 8 and 20 EMAs on my chart, but any similar EMAs would work, one quicker and one slower. As price travels upwards and downwards, it's accompanied by these EMAs, and in double tops, the EMAs will be below the price bars. Certainly in the first top, prices will probably be a reasonable distance above the EMAs. Typically, as the middle of the pattern forms, then prices will bounce off one or both of the EMAs. And this is what happens in uptrends. Bulls buy when prices meet the EMAs, as EMAs represent value. And the second top will see prices rise above the EMAs once again. As the second top forms, so the EMAs get closer to the price bars, and when price dips down from the second top, it will meet the EMAs, and it should cross the 8 EMA, at least the 8 EMA, and probably also the 20 EMA. And if it bounces here and goes higher, then this isn't a good sign for a reversal. Ideally, the signal price bar, which goes below the middle of the pattern, your signal bar for the trade, should also close below the 8 EMA as a minimum, and maybe even below the 20 EMA. And it should show very little rejection at its lows. There you have it then. These are the criteria to be met for the way I trade valid double tops. And I'll trade double bottoms in exactly the same way. So now we're going to have a look at some examples, and you'll probably have noticed that there are quite a few elements to take into consideration for these trades, and trading's an art and a science, and it requires a good education in order to understand it properly and be able to trade successfully. We've discussed moving averages, momentum indicators, the analysis of candlesticks and price action, all of these in this video so far. And you'll need to be competent in each of these areas in order to manage these type of trades well and make good decisions. And we offer a fantastic trading education covering each of these areas extensively in our trading training course, which you can take online. Let's have a look at this then as our first example. So this is on the GBP US dollar 5-minute chart, as you can see. And we've got a double top here. So you can see that we've got a resistance level here of 13,000. And price has already been up to that level and rejected off it once. And obviously the bulls thought that they'd have another go. Force prices back up, and there's a big engulfing candlestick here crossing the 13,000 level. But you'll notice that there's rejection on the top of this bar, a little bit of rejection there, followed by more rejection on the next candlestick, more rejection, more rejection. So 4 lots of rejection, 3 doji candlesticks there, 2 inside bars. This bar here and this bar here are inside the previous high and low, the high and low of this bar inside the high and low of this bar, and the high and low of this bar inside the high and low of this bar. So showing rejection at the tops, and the market came back down to meet the 13,000 level. And this became the middle of the double top. So you can see in the middle of the double top, this resistance level is acting as support for the middle, just crossed the middle, below the middle of the support level as it is now, and made its way back up. You've almost got a double bottom within this double top pattern. Prices made their way back up again and failed at the second high. And you can see the second high is a lower high than the first high. So no need to check the momentum indicator divergence here. and this bar here is a doji bar closing on its low, which indicates that prices are probably going to go down. And so prices did drop on the next candlestick. This is nearly a pin bar, just about a pin bar, and it closes. You can see the close here on this bar is just below the 8 EMA. So it closed below the 8 EMA. Not a lot of rejection at the bottom of this bar and quite a bit of rejection at the top. The market came down to the 20 EMA and bounced slightly. Bounced again, but it's failing. You can see it's failing to get above the 8 EMA here. And the bulls tried to put in another high, and tried to make a higher high and failed. And as they fail here and the market comes down, so the candlestick crosses the middle of the double top pattern, crosses below it, and that would be where you have your entry point. So thinking about the criteria here, we've got a resistance level which is exceeded twice, but it's causing resistance to prices, and you've got a good level of rejection here. This is white space, so you've got quite a bit of white space here, not a lot of congestion. There's a bit of congestion in here, but there's a gap between when the price crossed below the resistance level and the middle of the pattern. So you've got a nice bit of white space here, that's fine. And this bar closed below the 20 EMA, as you can see, and never made it back again. And so you place your protective stop up here above the second high, and your target would be the difference between the bottom of the middle of the pattern and the top of the highest high. So this quantity here, so you got your target easily on this one. And in fact, for swing traders who just take part of their position off at target, they would have got, well, 8-9 to 1 risk to reward on this particular pattern. So some nice profits from this one. And you can see that on the way down, prices never made it back above the 20 EMA. And so lots of traders will use that as a judge or a guide, if you like, as to when to exit their trades. So lots of people who use that particular method for running the last part of the money that they have on the trade, keeping it running, then they would have got a very nice trade out of that particular pattern. Have a look at the next one. So this is on the Euro US dollar 5-minute chart. We've got a double top here, and we've got a resistance level. So the resistance level, it's a minor resistance level on this particular occasion, but the 75 levels, they do play a part in trading, and we consider them a whole number or a round number, the 75 levels. And we get a double top, so we've got a lower high here and a higher high forming the double top. And when we've got a lower high and a higher high, then we also need to see a stochastic or a MACD divergence, a momentum indicator divergence. So you've got a price making a higher high here, and so we go down to the momentum indicator, and you can see that we've got a higher high followed by a lower high. So we've got a lower high and a higher high and a higher high and a lower high. And that's a divergence. So you can see that prices are making their way up, and this is a small trend. So it's making higher highs, higher highs, higher highs. And you can see there's a nice amount of white space here, and in actual fact the market came down below the 8 EMA, met the 20 EMA and bounced slightly back up to the resistance level, and it rejected nicely at the resistance level. So that's a minor lower high in there. And so that's good confirmation for a short trade. And you can see on this particular occasion that this was a big green bullish candle, and this was a big green bullish candle, but not quite as big as this one, and therefore that's indicating waning momentum. And what you've got here is you've got almost a coil in pressure, if you like, in these candlestick bars. If we analyse in detail what's going on in these bars here, we can see that this bar here formed, it's an outside bar, if you like, for all of these bars here are inside, the high and the low are inside the high and the low of this big candle here, and that's coiling up pressure. Traders will instigate trades when the high and the low of these big bars are broken by price, and you can see that it took several bars in order to eventually break this big engulfing candlestick here. So 1, 2, 3, 4, 5, 6, 7, 8 bars all winding up the pressure, and at this point in time nobody knew for certain where price was going to go, and whether it was going to break to the high of this bar, whether it was going to break to the low. But you can see, because price didn't exceed this and didn't really break through this resistance level, that the bulls are losing momentum and the bears are taking over. And this particular bar here closed below the 8 EMA, and it didn't in the next bar make it above, it didn't close above the 8 EMA here, and this bar here actually closed below the 8 and the 20 EMA, and that's a great signal. So when this particular bar takes out the low of the middle of the pattern here, then you're entering a trade short. So on this particular occasion, your stop will be above here, and your target would be from the difference between the top here and the bottom of the middle of the pattern. And it took quite a bounce here in order to make target. You can see that quite a lot of traders and computers who are trading will have taken profits down here. That's depending on where they set their stop. They may have placed their stop up here and set the target as the difference between the bottom here and the top here, and if they did, then they would have got out of their short trades here, and a lot of people did, because the market then forced its way right back up here, never threatened the protective stop, and then came back down to make target. Looking at this one then, this is on the SPY, the EFT, which is on the 5-minute chart again, and we've got a double bottom. So big move down here, big move down, and it reaches a support level, 24,250 support level. And this is a nice double bottom. So you've got a rejection of the support level back up to the 8 EMA, and then a move back down. 2 pins at the bottom here, indicating rejection of the second low, almost an identical low here, and then a nice bullish bar pushing back up off the support level. And the second bullish bar, second consecutive bullish bar, again it's a nice bar this, there's hardly any rejection at the top, no rejection at the top here. It closes above the 8 EMA, and so when the next bar moves above the high of the middle of the pattern, then you can be confident of trading this double bottom. And there was a little bounce off the 20 EMA, but again it bounced upwards off the 8 EMA, great sign. So lots of people will have waited and entered here and taken the trade up. So again on this one, stop down here, entry here, and target being the difference between the bottom here and the top of the middle of the pattern. Nice bit of white space in here, and market made it up. Again, here are traders taking profits from their double bottom trade, so exiting their long positions here, taking profits. Market made its way back down and then bounced off the 20 EMA upwards. So again, traders who are taking partial profits somewhere around here and then running their trades until they see a good strong break of the 20 EMA will have got 3, 4, 5, 6 to 1 out of this risk to reward, out of this particular trade. So a nice trade for swing traders as well as for scalpers. Next one, this is the Dow Jones 1 hour chart. So on this particular one, it's a 1 hour chart. You've got a little bit more definition in the price action here. And the double top might not be obvious, immediately obvious, but you've got bull trend, prices rising. You've got the resistance level here. This resistance level's 22,000. So big round number, big whole number on the Dow. And so prices rise up above it and reject off. So you've got the market coming back down to form the middle of the double top and then moving back up. And as you can see, this is a higher high. So we look back down at the momentum indicator, stochastic, and what we've got here is we've got waning momentum. So you've got higher high, slightly lower high on the momentum indicator, lower high, and the market's making higher highs all the way through this. So this is a good indication that people are saying, I'm not sure about this bull trend. Let's wait and see what happens. The bulls are more reluctant when it's becoming obvious that there's reluctance in the market. The bulls are becoming a little bit wary, and it's wait and see. The market comes back down, crosses below the 8 and the 20 EMA and back below the resistance level here, so it's not really providing much support at this point in time. Market makes its way back up. This isn't a particularly strong move. There are some fairly large bull bars in here, but you've also got some resistance from the bears here, a couple of bear bars, and the market makes a higher high and the momentum indicator makes a lower high. So that's a good indication that momentum's coming out of this bull move. And you can see right at the top here, nice reversal pin bar here, the last bar making the highest high, rejected down strongly and was followed by quite a big engulfing, bearish engulfing candlestick here. Took a little bit of time for the market to decide what it was going to do. Lots of people will have seen this as a lower high from a price action perspective, a lower high. It's rejecting the highs, and you've got a bear bar here closing on its low. You've got bear bars here, that one's almost closing on its low, and the market comes down. And as the market comes down, we're now trading below the 8 and the 20 EMAs. That's a great sign for the bears. And price dips below the middle of the double top here. So there's your entry. Stop above here. Target being 1-to-1 based on the difference between the top, the highest high in the pattern, and the low of the middle. And easily got 2-3-to-1 there. So lots of people taking their profits here. You can see taking the profits here. Market caused a slight bounce in the market back to the 8 EMA, and traders thought, no, we're going to have more downward action, and the bears were strong. When the market reached the 8 EMA here, the bears piled in with their short trades and forced the market back down really strongly. This is the chart of Apple, 5-minute chart of Apple, and this is a double bottom. Okay, so not quite as clear as some of the double bottoms that you can get, but it's a very viable trade here, and the main reason that it's a viable trade is because there's a strong support level here. That price is bouncing off this support level, it dipped below, and the bulls institutional traders said, no, we're not having that, it's going higher. And so lots of institutional traders will have taken these prices down here below the $160 mark as their signal to say, no, we're going to force prices up. There's good value in the market here, good value in this price. We're having higher prices. So the market went up, dipped back down, and you've got a strong bullish pin bar here, rejecting the second low, the second bottom, and then a huge big engulfing candlestick here, and this in fact I think was the opening candlestick. This is pre-market trading. This is the opening candlestick, and as the price went above the middle of the double bottom, first low, second low, then you've got your entry. Stop below here. It's almost an identical double bottom incidentally, and you do get a divergence, quite a divergence on the momentum indicator. Lower low, higher low, significantly higher low. That indicates to most traders who are paying attention that prices are going up. So you've got big rejection here, nice reversal candlestick, and the market's rising. And again, the market rose all the way up, didn't even break the 8 EMA till right up here. So good risk and reward trade again for swing traders. And 1-to-1, people taking profits 1-to-1 probably here, caused this spike here and the rejection back down temporarily. Also people taking profits here as well. Bulls taking the opportunity to, when price comes back down to the 8 EMA, bulls take the opportunity to get back into their trades, having taken profits higher up. Nice bit of white space as well here, you can see, and also here. Okay, this is the DAX 5-minute chart, so the German stock index. And can actually see, this is an interesting chart because you can actually see you've got a double bottom here, you've got possibly a double top or a head and shoulders top here, and a double bottom 1-2 here, and a double top right at the top of the chart here as well. And all of these price action was taking place around 3 important support and resistance levels. So the 12,425 level, supported price at the bottom, the first double bottom here. So you've got first low, second low. This is probably just a lower low. So stochastic divergence, you've got a lower low followed by a higher low. There's your confirmation, if you like, that this is a potential trade, and you've got a bullish reversal candlestick here at the bottom, a pin bar. You've got a red bear pin bar here followed by a bullish pin bar here. That's a really good sign. 2 elements of rejection right on the support level at the bottom of this second low, and prices paused very slightly, put in a minor pin bar here. That was good enough for the bulls to start getting into their long trades and trade this as a double bottom. And so when prices rose above the middle of the pattern here, traders are going long, and the market rose up easily to target. And again, probably traders taking profits here, causing prices to move back down to the 20 EMA. Traders taking profits here, causing prices to come back down to the 8 EMA. And so the market moved up to the 75 level, 12,475 level. It's not clear. The price action is not clear within here. And this is what I would term as congestion. You've got the market coming down, going up, coming down, going up. They're alternate bars, red, green, red, green, red, green. This is congestion. The market's pausing. It's pausing. It can't decide what to do. And so in this sort of situation, you wait and see what happens. And so the market came down. Nice bullish reversal, pin bar candlestick here. So prices came below the 20 EMA and bounced, and then went up to form, if you like, the middle of this double bottom pattern. So this is a double bottom in the middle of a bull trend. You can see that the prices came up, rejected back down to create the first low, up to the resistance level, back down, and then prices here are being supported by this red line, which is the 20 EMA, pushed up. They're being pushed up, and lots of rejection spikes at the bottom here. Gives a good indication that higher prices are likely. This is a bullish pin bar candlestick, nice powerful bullish candlestick forcing its way above the resistance level. So as prices rise above the middle of the pattern, you've got your entry here just above the resistance level. Stop goes down here, protective stop down here, target, difference between the bottom here and the top here. You've got a little bit of white space here. It's not ideal that, but it's good enough. All things being equal here, it's looking good for a long trade. And so again, target was made easily on this trade. I mentioned before that in this sort of situation, when you've got double bottoms in bull trends and double tops in bear trends, then very often you get what we call a one first leg equals second leg move. So you've got the move up here, double bottom, followed by a similar move to the first leg. First leg, pull back, second leg. Prices made their way up to the 500 level, 12,500. Made a high, rejection here at the high. Inside candlestick bar, high and the low of this bar inside this one. Another inside bar, another inside bar, another inside bar. Just came below the support and resistance level here, shot back up. Look at these bars here, these dojis here. This is indecision here, and that's a good sign. And so then the market came back down. Only a small trade this. You've got your target being the below the middle here to the high here, and made target here. This was actually out of hours trading, so you can see that these are all much bigger, much stronger bars, lots more volatility. Out of hours you get less volatility, but the market's in the same way. So I hope that you found all of that useful. That's how to trade double tops and double bottoms. If you found that useful, then subscribe to our channel. Lots more of these type of videos on the way. My name's Anthony Beardsall. If you're interested in learning how to trade, if you want to trade chart patterns, if you want to understand how to read price action, if you want to understand how to draw support and resistance levels on your charts, how to use support and resistance zones, then we've got a fantastic trading course for you that will take you from a beginner trader and give you a really good grounding in the profession of trading. So I'd be delighted for you to join us on our trading training course today. Thanks for joining me.